If you ever wondered why some stocks investment barely even keep up with inflation, while others turn a modest 10,000 into R1,000,000 over 20 years, then you're in the right video. Because today we're going to explore chapter 4 of what makes a multi-bagger stocks and what are the behaviors you can use as a template to identify a future multi-bagger. Hi everyone and welcome back to my channel. My name is John, former engineer turned full-time investor, wealth planning director at Phillip Capital and author of this book called The Malaysian Multibaggers. So we start out with a very pertinent question. Transforming 10,000 into R1,000,000 over 20 years. Now, if anyone tells you that they can do that within 1 or 2 years, please close your ears and run very far away because very, very likely it's a Ponzi scheme. But if you stretch it out to 20 years, then I think it is still very practical. Now, it is not a magic formula. What I'm going to showcase to you is actually a constellation of behaviors that through my research, through my own investment experience, manifests itself into what we call a multi-bagger stock. Now, those of you not familiar with the term multi-bagger, a two-bagger stock represents 100% return on your original investment amount. So if you invested in a stock at a share price of $1 and then it now becomes a $2 stock, that is a two-bagger. So for all the multi-bagger stocks that I've researched and some of it invested myself, there are 4 distinctive patterns that you should watch out for. The first one is being owner-operator or having a distinct capital allocator. Don't worry if you don't understand it now, I'll explain it later with examples. The second anchor is actually this thing called the twin engines. They must have a long runway for growth from a small base, and they will also enjoy a market re-rating. The third anchor would be this thing called the compounding effect, where they start small, there's a lot of friction, but the moment it starts spinning up like a gusing or a top, spinning top, then once it gains momentum, it will stay in motion. The fourth and also a very important anchor would be this thing called the fortress or the moat that the business will actually have. So I will break down all these 4 anchors into examples and companies that have thrived into multi-baggers by exhibiting these behaviors. When you buy a stock, you're actually buying into the business. Now, most assets, especially tangible assets like real estate, price is really driven by supply and demand. The beauty of equities and why I like it best is because it is a living, breathing, dynamic organism. A business model, even though it's great, but if you have a lousy operator running the business, a salaried CEO that worries only about his image or keeping his job or getting his salary, you're not going to get that kind of entrepreneurial spirit, the competitiveness that actually thrives in either adversity or thinking about scaling and hungry just to grow. So anchor 1 is this thing called the owner operator, or actually the capital allocator. Why I use this term capital allocator and owner operator is this. Now, I want you to think about the large government-linked corporations within Malaysia where I live. And it's, I think, the same for state-owned enterprises in China where they are civil servants, they're paid a salary, there's no incentive for them to actually get out of the comfort zone, but more to keep their job and not to, anger everyone at status quo, business as usual. Now, the owner operator, his entire wealth, a majority of his entire wealth is actually tied to the performance of the business. And when you have an owner operator who is hungry and who is shrewd enough to allocate capital, that means you should not spend things unnecessary. You should know what I spend 20% will give me 80% kind of impact. These are what we call shrewd capital allocators and hungry owner operators, because I believe this is one of the key factors, single most important factor for, let's just say, a mediocre business. Because most businesses in Malaysia, we're not Silicon Valley, okay? You're not going to get a Twitter or a Facebook, and you don't have that kind of talent pool at the moment. I mean, I'm not saying you can't in the future. At the moment, to be able to develop that kind of business model and have the capital backing. So business models in Malaysia are usually, because we started off as an agrarian society, now more into manufacturing and services. So these business models, they may not have fantastic business models, But if you have the right owner operator who is hungry, who is shrewd, these are the guys that actually can turn a mediocre business into a multi-bagger. And what we actually want is either founding families that still own a majority stake. They're not salaried, as I mentioned earlier, and they treat the balance sheet as their own. They're not going to fly. There's a company in Canada that started off. He was a PE fund manager before, and he treated the company balance sheet like his own. He never flew business class until he was a billionaire, and he did not even wanted the company to pay his business class ticket. He actually forked out his own money so that he would treat shareholders fairly. We do not have that kind of stories out open in the public here, but I can tell you some of the owner operators of multi-bagger stocks that I have been humbled to meet. They really treat the balance sheet like they own. They will not even fly in business class most of the time. They don't even have corporate jets, even though they can afford to, and they have to do business within Asia. They are frugal in how they treat their clients. Not to say until they become stingy, but they become frugal, because it is really the entire wealth, majority of the entire wealth is actually tied to the performance of the business. So really, pattern one, capital allocator, owner operator. Examples that I can share with you would be, the engineer founder, Mr. Kwan Kam Horn of Hartalega. High school dropout, taught himself how to make gloves. His family came from the property development construction business. Okay, so gloves was new to him, just curious, just hungry to learn. There are other founders like the visionary, Tan Sri Jeffrey Chia, accountant by training. He looked at a piece of land, former tin mining land. It was toxic, it's inhabitable. And yet he managed to turn that plot into what we know today as Sunway, the whole ecosystem, Sunway City, right? Thriving city. And last but not least, the family machine, Dr. Chia Song Kun of QL Resources. He was the only one in his family to have a tertiary education, but he never forgot his roots. He always thought about how to create economic sustainability for his village, his fishing village. And my gosh, he built a legacy over 15 years, over 20 over years, building the business and scaling it until today. Now more than 20 years, sorry. But he spread that wealth over his 15 siblings that, allowed him the opportunity to study. And now he's trying to bring that benefit back to them and the family. So there you go, owner operator, capital allocator. Anchor number 2, which is the twin engines. Now, what do I mean by twin engines? So first and foremost, if a company is doing revenue of 100 million and it wants to hit 10 billion, which is 100 times the size, it's much easier to do than a 10 billion company trying to hit 1 trillion, both in terms of either revenue or market capitalization. The runway or the market saturation is really longer when you start from a small base. So you need to find that ugly duckling that actually turns into a swan in the future. So if I were to break it down into more specific terms, I think you need to find businesses, listed companies, in a market or in industry where there's a very large addressable market. Now in Malaysia, a population of 33 million people, even if you sell goods and services, that's probably one province in China, or 33 million is probably the greater Tokyo metropolitan area. What I'm trying to say is that the market size for a listed company in Malaysia, unless it's a very high margin product or something that is very consumable that you change day in, day out, right? You're not likely to find a very long runway for addressable market in Malaysia. And most of the multi-bagger companies within this book actually have a sizable export market. Okay, buy a company when they are just undergoing this. They've proven themselves, but at a small scale, they may not be like P rated of 30, 40 times. They may be about let's say 15 to 20. But you see the ability to scale. You see the industry actually has an export market, long runway. This is when you find them when they are a boring duck. And when they hit their stride and they start delivering growth, profits year on year, operating cash flow year on year, free cash flow year on year, then people will say, hey, this is not a duckling anymore, this is actually a swan. And that growth combined with that PE re-rating from an ugly duckling into a swan, that is what I mean by the twin engines. So there are examples of, okay, so an example I gave in the book is actually this company called Franken. When we were looking at them early on, they were probably a PE of about the teens to the 20s. And if you look at Franken today, they are in their high 40s and 50 times because people actually recognize them as a swan today, no more of ugly ducking. And that is what I mean by PE re-rating. Anchor number 3, the compounding flywheel. Now, if you ever play the top, at the beginning when you try to spin it, there's so much friction that goes into it. You have to put in so much force in order for you to start that spinning momentum for the top. But the moment you release it and it starts getting into a stride, you notice that top just, it's very, very self-sustaining, and it's very, very hard to disrupt. That is the essence of what I mean by a compounding flywheel for a company. Any business, when it starts, they have to find a product market fit, they have to find a competitive advantage that their other competitors cannot do. And sometimes at the beginning, it's not very obvious until you really, really study and say, are they doing the right thing? I mean, if you look at any e-commerce providers within Malaysia, Lazada came, Shopee came, and yet Lazada, being the incumbent, has lost out its market share to Shopee, even within the Southeast Asia region. So that's an e-commerce example. I give you an even longer example for the gestation period. So let's just say you've found a business where it is a utility-like business, where you have to put up a lot of capex up front to build, but then you get sustainable and recurring cash flow over the next 20 to 25 years. These are utility-like business models. And one of the examples I gave in the book is actually Megafirst Corporation Berhad. They actually own this hydropower plant in Cambodia, selling electricity to, in Laos, selling electricity to Cambodia. It's called the Don Sahong Hydropower Project. And from there, when they started and the project gestation period, it was easy between 10 to 15 years before you can even realize your first dime of cash. You have to take on debt, you have to build, you have to manage project risks, only then you can see the kind of returns, right? Syntex, they started off as a plastic manufacturer, right? Thin film plastics, packaging, and yet they were very shrewd in having a property division where cash flow generation was good and allowed them to actually reinvest into very capital intensive, better, more technological, advanced packaging, plastic packaging, manufacturing equipment. So these twin engines, cash flow generation, and then into plastics, long gestation periods as well. You need this kind of momentum to actually continue growing. And last but not least, again, QL Resources, they started out with fish meal. Then they went downstream. They went upstream, and then they went downstream, and then they conquered the whole vertical chain, including midstream. And now they distribute their own products through, the convenience store, franchise, Family Mart. So there you go. Anchor number 3, the compounding flywheel. Last but not least, anchor number 4, the moat or the fortress, or what we call the durable competitive advantage. Now, for those of you who want a deeper explanation about the different types of moats, which I won't go into very detail here, there's a link. I keep on getting confused, either on the left or on the right, a video card that you can go and watch my previous video that explains moat in more detail. But I will summarize it here. The moats that we see in Malaysia are usually low cost producer. Cost advantage. Switching cost, that means how difficult it is to say goodbye and to switch to another provider. Intangible assets, either protection of their business model through regulation or either through a brand name, like Ferrari. Everybody knows a Ferrari, right? And the last but not least is actually the network effect, or an integrated ecosystem where it's very, very hard for you to leave, because as it scales, people don't want. WhatsApp is a good example. Why people are on WhatsApp is because your friends are there. Facebook, even though it's the younger generation will say it's an older, it's more catering for the older folks, but you go out to check friends and family there, right? Because of this network effect. So Press Metal had a cost advantage because they had sustainable and reasonably priced electricity in Sarawak, right? And they had this 25-year agreement and a tariff to allow them to produce electricity cheaply, allow them to produce aluminium extrusion products cheaply based on this power supply agreement, right? Switching costs. How long does it take you to qualify your products or services? If it takes you 2-3 years, or sometimes even 5 years, then you have an advantage compared to your competitor. Let's say a competitor comes to you and says, okay, I'm going to provide this service 20% cheaper than whoever, let's say in this case, Frontcan, right? But it takes you 2 to 3 years to test, to qualify. Now, for the client who is going to decide, do you want to take that hassle of requalifying a new vendor, and 2 to 3 years later, then you realize, oh, no, it's not going to work out. So there you go. That is actually the fourth anchor, which is a competitive advantage, the fortress that allows a company to continue to compound. Unless you have that moat, you will not have that runway to be able to allow you to compound. There's an old Asian practice where you save money for a rainy day in a can of Milo malt drink. This is a practice that, most Malaysian families had, since World War II. Obviously, it's not regularly practiced today, but I think it's the concept or the mindset where you soak away money for a rainy day and you don't get to touch it or to see it, right? That is the essence of what I'm trying to bring about in this video. You recognize these 4 patterns that I just described, but then a lot of times there's a lot of noise within the market that tells you, today, as we're filming this, is the US-Israel-Iran war, right? Few months ago or 1 month ago, it was the SaaS apocalypse, because they say AI can take away software programming, there's no need to do programming. Or, in 2025, there was the Trump tariff, tweet that caused the market to actually have jitters. So there's a lot of these noises in the market, and it causes anxiety, and humans are very emotional. But if you done your analysis, you identify these 4 patterns, what you need to do is to behave like saving money in the Milo tin. You understand the business very well, you have your conviction, you build your conviction over time, then you put in your allocation, you invest into this company, and you see that, you look at the quarterly reports or even the half yearly or yearly financial reports, and the business is still growing. Story has not changed, all right? There's no long-term detrimental impact to the business regardless of all these short-term noises. That's when you should just do nothing. And that's why I coined it the myotin mindset. Done your homework, invest your pot, that's it. Don't disturb it. Don't disturb compounding. It's like you're trying to plant a durian tree, right? Do you dig up the roots every quarter just to check whether it's doing well? Your tree will die, right? You just let it, you just water it. Yes, there may be diseases, yes, there may be insects that come and attack, but you try to protect it as much. But if the roots are strong, if the tree breed is strong, because you've already selected it in your homework process, then just allow nature to take its course. Allow the tree to grow, and in this case, allow the businesses you have invested in to grow. Then only you can enjoy this kind of multi-bagger returns. So let me know what you think. In the next video, I'll be covering more chapters, more specific industry chapters, but I'm looking for, I've already decided on the date for the book launch. If you can make it, it will be on the 28th of March, which is a Saturday afternoon, 2 p.m. at MPH Bookstore in TRX. I look forward to seeing you guys there. If you want your book to be signed, and if you want to buy an early bird copy where there's a discount on Shopee today, the link is in the description below. And I do look forward to seeing you in person on the 28th of March, 2 p.m.